Imagine starting every month with revenue already on the books. Well, that is the power of recurring revenue. It is predictable, scalable, and resilient. Well, that is also the focus of the Rainwater Equity ETF. And here to explain is Joseph Shaposhnik, Portfolio Manager of the Rainwater Equity ETF. Joseph, it is a pleasure to have you today.
Great to be with you, Stephanie.
So before we discuss your latest ETF offering, tell us more about your firm's unique investment philosophy and approach.
I founded Rainwater Equity after serving as portfolio manager at TCW for many years and prior to that at Fidelity. And I really founded the firm because I felt the mutual fund industry, particularly on the equity side, is just broken. 93% of funds underperform their benchmarks on most measurable periods, 1 year, 3 year, 5 year periods of time. The industry just doesn't work. And I believe the reason the industry is broken is because portfolio managers take a flawed approach to investing. And that flawed approach is looking at every individual business in an index and trying to come to a conclusion as to the future prospects of that particular business. That approach doesn't work. And the reason it doesn't work is I believe most companies can't be predicted. We take a different approach. Our approach is we're only going to focus on those businesses that we think are predictable. And those businesses that we think are predictable are recurring revenue businesses.
The Rainwater Equity ETF, and your ticker is RW. It is among your latest ETF launches. First of all, congratulations there. What types of stocks does the fund own, and what are the types of companies that we might expect to see within the fund's portfolio?
Well, we only own recurring revenue businesses, and so that means that their revenues are tied to long-term maintenance contracts, like software companies that have 2 or 3 year maintenance contracts. That means credit bureaus, which command a high market share and have a significant amount of business that's very recurring. That means aftermarket aerospace parts, which need to be replaced as planes fly on a very regular basis. They tend to be the only suppliers of those parts. Those are the types of businesses that we own in the portfolio. And of course, we focus on a three-point strategy. 1, only own recurring revenue businesses. 2, invest with great leaders. And 3, hold stocks for the long run.
So how do you see the Rainwater Equity ETF potentially being used by financial advisors and investors?
In my view, RW is a great replacement for an existing allocation to one of the broad market indexes, which today are highly concentrated, more concentrated than they've ever been in the history of the market. So RW will provide an investment advisor with a portfolio that has greater stability because of its focus on recurring revenue businesses, the opportunity for higher rates of growth and compounding because these businesses can redeploy their excess free cash flow to activities that will create more free cash flow and more growth. This provides, in the event that the advisor would like to pair this with an index fund, this provides them with significant diversification relative to their index position. Because we don't own the large index names, we own a collection of recurring revenue businesses that are small caps, mid caps, large caps, both domestic and foreign. So it's a great diversifier to an existing index-oriented portfolio. And of course, it's run by a manager that has a long record of doing this at a prior firm. So a track record that one can take a look at and evaluate.
And we are going to leave it there. Joseph, thank you so much for your time today and sharing more about your ETF. We appreciate it.
My pleasure.